Hi, it's Lori with Elga Credit Union, working with you to make you financially fit. Today our topic is credit score. This is one of those things you need to be healthy for so many reasons. This video is going to be done a little bit differently than the others. It's going to be built into chapters. So if you are worried that you're not going to be able to get through it all at once, it'll be easy to pick back up because you can pick up with the chapter that you finish on and pick it up later. The purpose of FICO credit scores is to assist a lender in making a credit decision and to predict the likelihood of becoming 90 or more days delinquent over the next 2 years. FICO scores range from 300 to 850. The higher the score, the better the interest rate you will get and the more likely the lender views you lower risk. So, you heard me say the word FICO. A FICO score is coming from one of the 3 credit bureaus. If it is not a FICO score and someone tells you that they're giving you your credit score, it could be an app or different things like that, know that that may be a little bit more significantly different. A lender is going to look at one of the 3 FICO scores. Let me talk to you a little bit about the reasons why you would need a good score. First and foremost, a good score increases your chance of a lender approving a loan request for you. Another reason might be an employer could use the score to see if you might be a good risk as a new associate to their team. Insurance companies use credit scores to evaluate the risk you represent to them, and this helps them set your premium rates. Therefore, the higher your credit score, probably the portion of your insurance score that predicts how well you'll do on your credit score improves that portion. So the higher your credit score, the lower you're going to pay for your car insurance. Obviously, insurance is going to have many other factors, but that is one of the factors. A better score will save you money. So let's talk about terminology a little bit before we get into all of the different parts of the credit score. FICO also is known as Fair Isaac Corporation. So FICO is just an abbreviation of the Fair Isaac Corporation. A trade line. Trade line is an individual loan account showing up on your credit report. Underwriting. This is the process by which a lender determines risk and decisions a loan request. Installment. This is a set loan amount and payment amount. Revolving, limits on a credit card or equity account that can be paid and charged up again. That means the payment amount could be different every single month depending on that balance. Capacity, the amount available on revolving trade lines. So there are 3 national credit bureaus. Those credit bureaus are Equifax, Experian, and TransUnion. I want you to note that each one of these 3 separate bureaus could have a totally different score for you. Now, the score is still going to be within range. If you have a high score with one, you should have a high score with the other 2. If you have a low score with one, most likely you'll have a lower score on the other 2. But I want you to understand that the 3 scores will be different, and that's perfectly fine. That is normal. The reason that different scores may happen between the 3 is first and foremost the information. It could be because of a maiden name reporting something that another bureau didn't catch up. It could be the difference of a middle initial, things like that. It shouldn't, because it should be going by social security number, but the information from one credit bureau to another could be slightly different. The second reason that the score will be different is because of the timing. So when the timing of when a lender reports to each of these 3 credit bureaus are different, that could actually affect your score. So if a lender that you have with one credit bureau is sending their information, let's say toward the end of the month, and another one at the beginning of the month, think about your credit card balances. Because of your credit card dates being due at different times of the month, that might significantly impact your score. because you might have had a higher balance at one point throughout the month, and after you pay it, it would be lower. So that's another reason that it could be different from one part of the month to another. What is a good score? That's a great question. In most typical lending institutions, I would say 720 is what they're looking for. That's A credit with almost everybody. So that's a score that eventually you should be striving for. Now, there is something called risk-based lending, and that's what Elga Credit Union does. We have a scoring system because we know that not everybody can be at a 720. And if that were the case, if only 720 could get a loan, we would have a lot of people in our county and in our state who had trouble getting car loans or other loans that might prohibit them from even having a job without public transportation and many other things. So risk-based lending is good for so many reasons. We can work with you where you're at today. Will you get a higher interest rate? Possibly. But the good news is with the risk-based lending, we work with you where you're at today. We educate you and teach you how to continually get that score increased. So with Elga Credit Union, we will take a 680 or higher as our A credit. From 679 down to a 640, we would consider that B credit. 639 down to 600 would be the C credit rating. 599 down to 560 would be our D credit rating. And anything 559 or lower would be our E credit score. So we'll get into the score again at the very end of the presentation, but I wanted you to understand maybe where you might be in your range for credit score right now. Now we're going to get into what really makes up that score, what components. These 5 components that you'll see on this pie chart are the things that are the most important that are affecting your credit score. So the very first thing and the biggest piece of the pie, 35% of your score is all about your pay history. That is the most important thing I'll talk about in this seminar. 30% of your score is all about amounts owed. 15% of your score, length of history. 10% of your score, your credit mix. And 10% of your score has to do with new credit. I'm going to go through each of those sections and you'll be able to understand a little bit about maybe what is affecting your score, and you'll be able to pinpoint the areas that you want to improve on. Let's take the biggest piece of that pie. 35% of your score is all about the pay history. Well, pay history isn't just your trade line that you're currently actively working on. It could be other things. Let's get into that. One thing that is about your pay history is a public record due to bankruptcy. If you had a Chapter 7 or a Chapter 13 bankruptcy, those will stay on a public record. So a Chapter 7 will stay on your public record for 10 years, and a Chapter 13 will stay as a public record on your credit bureau for 7 years. One other public record you might see on a credit bureau is an IRS tax lien. That could stay on there as well, and probably much longer than the 10-year mark, depending on how long it takes you to pay it. The next thing that affects the pay history is collections. These are usually going to sit on the credit bureau for approximately 7 years, but it could be longer. Now, the reason I say it could be longer is because we tend to see debt sold and then resold and resold again. When that happens, it could restart again, that 7 years. So you want to be careful of that. So collections, time since the collection was put on your credit bureau or time since an account was paid is going to be the factor on how your collections report for the score. Collections will stay on that credit report for 7 years from the original delinquency date of the original debt. If you have paid the debt, it will stop affecting your score about 24 months after the debt has been paid. Now that one is tricky. Let me explain that a little bit. Let's say you had an old collection that was medical for something real small. Let's say $50. and you got that 5 years ago and did nothing with it. Well, it's still sitting out there. It's no longer affecting your score because it's old. It's 5 years ago. However, you're going to need to get it paid if you want to get, let's say, a house, because usually when somebody is financing a house for you, they like to see your collections paid. If that's a requirement, you've got to pay that $50. I just want you to be aware when you pay that, what you're doing is triggering an old collection that's no longer affecting your score. You're waking it up. It's what I call waking up a sleeping dog. It was no longer affecting your score. When you pay it, you'll wake it up. And for 24 more months, it's going to affect your score. Then your score will start to increase from there. The best thing to do is not get a collection. And if you do get a collection, pay it as soon as possible so it doesn't linger out there for 5 years and 7 and 10 years and so on and so forth. Next, I'd like to talk about late pays. So every single loan that you would have on your credit bureau, it could be loans based on credit cards, consumer loans like your auto loans, or even a mortgage. Those are all your trade lines, as we had discussed in terminology. When you pay one of those late, it will affect your score. So the trick is understanding what is really late. So most of you are probably thinking late means 1 day late. Well, yes, it would be late maybe to the lender if it's 1 day late, and some lenders may charge you a fee if you're late. But what I want you to understand as far as the credit bureau is concerned is you are not considered late until you hit 30 days late. Now, I did say 30 days. I did not say 1 month. That's another important thing to know. Different months have different days. And so if you look at the month of February, if you had something due on February 1st, on March 1st, you aren't a full month yet. But in the month of March, because it has 31 days, if it was due March 1st, technically you would already be 30 days late on the 31st of the month. So looking at those things in those manners could make a difference. So if you hit 30 days late, it will negatively impact your score, and you will be knocked some points on your credit bureau. So if for some reason you have to pay something late, don't freak out. Pay it. Pay that late fee with it if there is one. It's still going to be fine as far as your credit score is concerned. The next section of the credit bureau I'd like to talk about is the amounts owed section. This section is quite valuable to your credit score because it's 30% of your score. This section is a little tricky. Most people think they understand it, but let's make sure that you do. You'll see there at the top part of the example, I've noted a student loan and a vehicle loan. These are installment loans. That means an installment loan is something that gives you a specific period of time to pay it back. So when you get a car loan, you might take it out for 4, 5, 6, maybe even 7 years if it's really new and a higher dollar car. And the lower dollar cars might be a 3 to 4 year term. As long as your balance is going down, you'll look at the vehicle loan and see that we borrowed $8,000. That was the limit that the credit union or the lender gave us. The balance is only $4,292. Because the balance on the vehicle loan is going down, that is pushing the score up. Now look at the example of a student loan. This one is tricky. A lot of people do not even realize how student loans could hurt their credit score. So if you'll look at the example, what does it show for the limit on the student loan? You took out a $3,000 loan in this example. Now, an installment loan expects on a credit bureau that the balance is going to be going down. So even somebody who calls a student loan company and says, listen, I know I'm supposed to start paying on my student loans, but I don't have enough income coming in right now to be able to justify the payment. Could I get those payments deferred, or could I put my student loans in forbearance? Now, even though they've allowed you to do that, on the section of the credit bureau where it won't affect you is for the on-time payments. The portion we just talked about, 35% of your score about paying on time, you will not be affected if you've deferred them or put them in forbearance. However, what happens on the amount owed section is you have an installment loan. That portion of the credit bureau expects that your balance will be going down. Since it's not with a student loan, what happens is once you're responsible to start paying those back, even if they're in deferment, you're probably being charged interest. So in this example, let's say that 5% interest is the interest rate on that $3,000 loan. What's happening is about $12.50 a month or $150 a year is the interest on that $3,000. So the balance in this section I'm showing you is $3,313. What that's saying is basically for 25 months, interest has been tacked on to this loan and the balance continues to go up every single month. So until that balance is lower than the limit, that is negatively impacting the credit score. It's pushing that score down. So imagine that you have this situation. One way to clear it up on an installment loan is to pay the balance down below the limit. So if somebody were to say, I do have $3,313 owed currently on the student loan, how would I start clearing up my credit score if this is my situation? Well, that's easy. You can clear it up in a day. Pay more than $313 to get that balance down below the limit that was set. So maybe make a $350 payment. All of a sudden, your balance is starting to go down. From that day forward, keep paying on it, because if you stop paying on it again, the balance is going to go back up because interest will be added on a monthly basis for that loan, which means the balance will keep going up. So as long as you can get that balance down below the limit and keep paying on it so that the balance continues to go down, that's going to push your score up higher. Okay, next we're going to talk about revolving debt. So at the very bottom of these examples here, you'll see credit card A, B, and C listed. That is revolving debt. If you happen to have a HELOC, that stands for home equity line of credit, which is on a credit card, you'll also be looked at as far as the credit bureau is concerned as revolving debt. So on the credit cards or the HELOCs, you'll want to be understanding what your limit to your balance is as well. So let's say you have, like in our example A, credit card A has a limit of $10,000. It has a balance of $3,000. That means 30% of the card is used up. The capacity is 70%. That is perfect. You could have that or anything less used up as far as the balance goes, any lower balance, to have that credit bureau score as high as it needs to be. So even using 30% of your card up, as long as you've got 70% capacity or higher, you are pushing your score up. Now, if you have an example like card B or C, let's say you have a credit card that has a $4,000 limit and you've got $2,300 spent on that, 58% of the card is used up, leaving the capacity level only at 42%. If you're in that kind of a situation, it's probably pushing your score down. And the same with credit card C. Remember, even though it's a small amount, I wanted to show another example of when it's pushed down because it might not even be realized. This one is a credit card limit of $500 and a balance of $250. $250 is not that much money to have to pay. You would think it wouldn't negatively reflect on your credit bureau, but you've used up 50%, which means the capacity level is only at 50%. It's not quite high enough to push your score as high as it could be going. So no fear if you're in one of these situations where you're pushing your balance or your score down because of your credit card balance or your even consumer loan balance on maybe a student loan. You can clear this up and you can clear it up quickly. You don't have to wait 24 months. You don't even have to wait 7 to 10 years. You can do it in days. weeks. It's not that long to take care of. You just pay that bill in full, or for a student loan, you get that bill paid down to where the limit is, or the balance is lower than the limit, and you'll be fine. With a credit card, you want to make sure you're keeping that capacity at 70% or higher, meaning you only use up about 30% of the card or lower. So do I always keep my credit cards to this percentage? Yes, as a general rule of thumb, that's my goal, is to never go over that capacity limit that I'm telling you to stay at. But something that you'll also want to note is if you do put all of your bills on your credit cards because you like to take advantage of reward points and things like that, that's okay. Just make sure to pay that bill in full each month, and as you do that, your capacity level goes back to the 100% after it's paid in full, and you're fine again. Now, your score will go up and down based on how much you've utilized on that credit card. That's going to happen month to month, and I want you to understand the reason for that is because your due date on your credit card when you've paid that may be a different time of the month than when the lender has reported to the credit bureau agencies. And so what could happen is the last time it reported, you might have still had that balance out there. So it could take as much as a few weeks. But depending on the time of the month that you pay and the time of the month that the tapes are read by the bureaus, it could be days. So keep that capacity lower, but again, it's not going to take you long to clear that up. The next thing we're going to talk about is length of credit history. Now, this is not as important as the two sections we just went over. It's only half of the value on your credit score as the other two. Now, let me give you an example. I have two girls who are teenagers, and I've worked with them already on their credit and their credit score. And I'll tell you, you can get into the 700s within months of starting your score. So you do not need to worry. It's not going to take you 10 or 15 years to be A credit. Really, you just need 6 months minimum to get into the 700s, and you could even be at A credit between 6 and 12 months time, and you'll be there. So if you're just starting your journey, no fear, you can get there quick. It's clearing up the bad stuff that's going to take a little longer to get you into the 700s. If you're just starting out, you've got time on your side and you're going to get there. So length of credit history may not hurt you so bad. It's still going to get you into the A credit range if you want to be and you've done everything right. The thing that credit history is, or the length of your credit history is not going to help you with, is if you're one of those who says, listen, I don't want to be in the 700s, I want to be in the 800s. Well, that's going to take some time. That's the thing that happens with young people trying to push their score into the 800s. You've just got to keep the history with your trade lines open for a long time. So, for example, once you get that Elga Credit Union credit card, use it and keep using it for years and years. Become a member and stay a member. Keep that card open for 30 years or more. That is going to push that length of credit history time for you because you've had that same card open for a length of time, and that trade line is going to always stay open for you. That's the key to doing things like that. When you open a mortgage and you leave it open for a long period of time, that's helping you. That's the things you want to do. So let's look at this example. Let's say you've had a student loan and you received that about 5 years ago. That's when that was opened. A vehicle loan 4 years ago. Credit card A was opened 2 years ago. Well, credit card B is new enough that it doesn't even have a full year yet, so 0 years. What the credit bureau is looking at is the average age of all the years that you have had your trade lines opened divided by the number of trades. So in this case, we have 11 years of history divided by 4 trades. My average history is about 2.75 years. Now imagine what would have happened had I had one of those for a lot longer. It would have given me a longer history. So the first indicator or clue on the credit history is once you open up a trade line, don't keep refinancing it often. I mean, if you need to get a better rate with a car loan or something like that, that's good to do. But you don't want to be refinancing your house every single year. If you do it at one point because of rates dropping, that's fine. But one thing you want to make sure of is to keep one of your cards open for a long period of time. Just leave it open. I would suggest that be your credit union credit card. Those are usually typically the ones that have the lower interest rate. Now, the second thing I want to talk to you about is opening too much and you do it at once. So somebody just starting out, let's say that 18 to 22-year-old who opens a lot within a couple of years, they're not going to have that length of history. So if you open up a credit card and a car loan all in the same year and that's all you have 0 years on your side. That's okay for that first year, but as you grow your history and your credit score, you want to make sure that you're looking at not doing too much the same year, because you're just keeping that low years for a long period of time. So length of credit history, the main key is once you open something, mean it, stay with it for a while and keep it open. That's why you want to make your first credit card a smart choice and have a credit union one. So as you add new credit cards, this could bring the average age down, as each new card will have 0 years to start with. If you've got a high credit score and a long length of history, it's not going to impact you as much. It's those people who have lower years on their trade lines opening too much too often. Again, if you get up into that 720 or higher, you're not really hurting yourself. It's just for those people who really want to push it higher. All right, next, let's talk about the last two areas of your credit score. 10% of your score is all about the credit mix. So the FICO or credit bureau score is considering your mix between mortgage accounts, installment loans, and credit cards. Mortgage and installment loans both have fixed payment rates and terms. However, your revolving credit, meaning your credit cards or home equity lines of credit, don't have terms. You can pay the minimum payment or more each month. The majority of your credit mix should not be in revolving accounts. Something to be aware of here again is a HELOC, a home equity line of credit, could also be looked at as revolving. So this one is pretty simple. Have a mix of credit. Don't have all credit cards on your credit bureau and that's it. You want to have some installment loans, meaning your vehicle loans or a student loan, maybe even an unsecured loan as well. You need to step it up at some point maybe and get a mortgage on there. Those are the types of things that give you a good mix. Don't just have all credit cards. That's it. All right. We are on to the very last portion of the pies. The last 10% of your score is about new credit. So getting your credit pulled, hard pulls too often is maybe going to hurt that score. So you want to limit that to 1 or 2 times a year that you're applying for loans. You don't want to be applying for loans every single month. Tell a quick story right now about a lady who one time I was working with. She had applied for 8 to 10 new credit cards all in the same month. And I said, why would you do that? And she said, well, every time I was applying for these, I was school shopping and they were giving me 10 to 20% off of my purchase that day. So for, let's say her $100 purchase, she got $10 off for 10%. Well, for that $10 that she was given, I'm going to tell you she paid way more than $10 because her score dropped so much with all those hard pulls that she lost a significant amount more than what she gained by that 10% off coupon for that day. So you want to think about this. Don't let everybody pull your credit. Everywhere you go, somebody is going to be asking you. When you're standing in line to check out, that store is going to ask you, that grocery store, that bulk food store, clothing store, you name it. They are paying their employees to open these credit cards, and they're asking, you know, would you like to open our credit card today? We could get you 10 or 20% off your purchase today. For that one-time coupon, you are paying basically for it in a long-term manner. If you're planning on getting a car that year or a different kind of a credit card that might be more important where you could spend it everywhere and not just in that one store, you want to think about that. You don't want to be opening that card. It's very easy for me to say no because I like to have a good credit score and I want to keep that high. So with new credit, be very conscious about considering how many times you do give your social security number away to have somebody pull it for credit, no matter where you're at. So a good rule of thumb, and I'm just going to give you the best idea of, let's say you're car shopping and you're really wanting to look at cars for a while. The best thing to do is ask the lender how long your pre-approval would be good for, and start at the lender. Don't start at the dealership with the car and give every dealership you go to your social security number so that they can help you find a lender. You want to get that lender you like to work with. So for example, you know I'm biased. I like Algo Credit Union. I would like to get my pre-approval through them, find out exactly what my score is at, how long my pre-approval is good for, how much I can borrow, what my interest rate and payment are going to be. I go in with all of the known factors. Now, if I know exactly how much I can spend, I'm not going to get myself into a bad situation. I walk into the dealership now, let them know my financing's already taken care of. I just want to see in my price range what I'm going to have for options. And if you want to look at 3, 4, or even 5 dealerships or more, that's okay, because you're not getting your credit pulled at each one. You're just car shopping, and you don't have to be worrying about your credit score because it's already taken care of. You've got your pre-approval, you know what you need to do, and now you can let them do the job that they specialize in, and that's selling cars. So, new credit, my advice to you is just get it pulled maybe once or twice a year. Let's talk about time weight. The older it is, the less it's impacting you. The newer it is, the more it impacts you. So the last 0 to 12 months is 40% of the score, 12 to 24 months, 30%, 24 to 36 months, 20%, and 36 to 48 months, 10%. So your time is weighted based on how recent it is. If it's really old, even though it's still on your credit bureau, it's probably not reflecting in your score. Let's go over the things that hurt your score. The most frequent and or recent late payments and derogatory public records. A low level of capacity on an individual credit card. Closing a credit card account. Lenders removing or lowering credit card limits. Multiple new trade lines in a short period of time, and making payments on old debts, like I showed you with the collection example. Things that will improve your credit score are ensure your credit bureau is accurate and dispute any errors that you find. Focus on bringing delinquent loan accounts current. Comparison shop for auto, mortgage loans, things like that within a 30-day period of time to minimize the impact of your inquiries. Pay off and close finance company trade lines. Pay down credit cards near their limits first. Pay down total revolving balances. Do not close those accounts unless you are required to. Move your revolving balances to installment debt, but don't close the card, these accounts, unless you have to. Minimize your inquiries and minimize your new accounts. Let's make sure you understand what is not included in your credit score. Race, color, religion, age, national origin, sex, and marital status has nothing to do with your score. Where you live, your salary, your occupation, title, employer, date you were employed, and your employment history has nothing to do with your score. Interest rates you currently are being charged on your loans, nothing to do with your score. Credit counseling services. Soft credit inquiries, meaning the promotion letters you get in the mail, employer inquiries, your insurance inquiries, things like that are soft pulls. Those are not included in your score. Let's go over the truths and myths of credit scores next. Truth. If you co-sign for a loan, the impact to your credit score is the same as if you were the primary borrower. Let me explain that one a little bit better. That means that if you co-sign for one of your, let's say, children or boyfriend or girlfriend, significant other, things like that, and they stop paying on their loan and they go delinquent more than 30 days, it will impact your score just as if you had paid that late as well. So you want to understand that as well. Negative information can stay on your credit report for 7 to 10 years, even if it isn't reflecting in your score. Credit scores can change daily. All 3 credit bureaus could have you at a different score. All of those things are truth. Now let's go over the myths. These things are not true, but I often hear people act like they're true. So, open as many credit lines as you can. Absolutely false. That is a myth. You should not be doing that. You have to keep balances on your credit card. That is not true. You can pay that credit card balance off every single month and still have your credit score increase. Pulling your credit report often means you care about your credit. Absolutely not. Don't do that. Remember, once a year is plenty. The score you have on a credit app website will be the same as what the lending institution sees. That is false. That is completely a myth. All right, let's go over some do's and don'ts. Things that we want to see you do. Purchase items you can afford with cash, not credit. Keep low balances on your credit card, 70% or more available, and pay on time. Those are all things we'd like to see you do. Things we don't want to see you do. Open every credit line that's offered to you. Max out limits on your credit cards or pay late. We are just about at the end. So let me show you what all of these things that I've just talked to you about look like combined. Let me show you the difference in interest and why that score matters. Next, you're going to see a slide that talks about a vehicle purchase. So we're just going to start with, let's say, an $8,000 used car purchase, and you're going to do that for a 48-month term, which is 4 years. Let's say you were in the A credit tier and we had given you a 3.25% interest rate. Your monthly payment would have been $177.98. Over that 4-year period of time, your total interest would have only been $542.82. So basically, $130 some per year is all you were paying in interest on an $8,000 loan. You can look and maybe stop the video and look at the other tiers, but let's jump down to that E tier. Having an E credit rating at 17.9% interest, the monthly payment would have been $234, and the interest paid over that 4-year period of time would have been $3,262. So the payment doesn't seem that much different. It's only $50 some different. But over time, the person with e-credit would have paid over $2,700 and some change more than the person with A credit. Imagine over every 4 years, you're paying that much more money than someone else for the same vehicle or whatever. That's going to hurt you over time. So the goal is to keep pushing yourself to the next tier up, to the next tier up, until you can get yourself in the best tier rating for you. Pushing yourself toward that A mark is always the key. Now, the good news is, again, I'll reiterate, even if you are Dear E credit today, the good news is somebody will still help you. Alga Credit Union would help you because we're a risk-based lender and we would love to help you. But we will also like to educate you on why you should continue to pay us on time and get that score up, and why you should work with your revolving credit card limits to not have them maxed. We want to see you improve on your score so that you can pay less interest on your next loan. Now, this is my little cartoon I like to end with. If you can see this little cartoon on the next screen, you'll see that I've got a gentleman holding all of his student debt on his back. My joke of the day is, those that understand interest earn it. Those that don't, pay it. I hope that you will be that person who understands interest a little bit better, because you now understand your score and you'll be able to work to push yourself to the point where you pay less interest and you have less debt to carry with you. We want to put you in the best financial situation we can. Thank you for watching. Give us a thumbs up or a like on the YouTube video so that we can continue to know that these are helping you, and we'll continue to make more. Why don't you make it a great day? Thank you.